Let's talk about something that separates successful traders from everyone else: risk management. It doesn't matter how great your technical analysis is. It doesn't matter how many indicators you use. If you don't manage your risk, you won't last in the market. In this video, we're going to break down what risk management really means, how to calculate position size, how stop losses work, how to protect your capital, and how to build a system that allows you to lose small and win big. Let's get into it. Why risk management matters more than any strategy. Most new traders focus almost entirely on entry signals. They want to know when to buy, when to sell, what pattern is forming, or what indicator to use. But here's the truth. Even the best strategy will fail without proper risk management. Why? Because markets are unpredictable. Even high probability setups can fail. News can break, algorithms can spike volatility, and price can move against you in an instant. Your job isn't to avoid losses. Your job is to control them and make sure they're always smaller than your winners. Risk management is the insurance policy that protects your account while giving you room to grow. Risk per trade, the core of your system. The foundation of good risk management starts with this question: how much of my account am I willing to risk on a single trade? The industry standard is 1 to 2%. That means if you have a $10,000 account, you should risk no more than 1% equals $100, 2% equals $200. That's the maximum amount you can lose on that trade if it hits your stop loss. This has nothing to do with how many shares you buy. That comes next. This is your risk limit, and it protects your account from blowing up. Even after 5 losing trades in a row, you'll only be down 5 to 10%, giving you room to recover. Once you know how much you're willing to risk, the next step is to determine how many shares you should buy or sell. Here's the formula. Let's break that down. Suppose you're risking $100 per trade. You want to enter a trade at $50 and your stop loss is $48. That's a $2 stop loss per share. So your position size is $100 divided in $2 a share equals 50 shares. This is how real traders operate. They don't buy random quantities. They calculate position size based on risk. Why fixed share sizes are dangerous. Let's say you always trade 100 shares of any stock, no matter the price or risk. On one trade, the stop loss is 20 cents. That's a $20 risk. On another, the stop loss is $2. That's a $200 risk. If you're inconsistent with your stop distances and still using fixed share sizes, your risk is all over the place, and that creates volatility in your results. Your position size must adapt to your stop loss. Your stop loss is the price level where you say, if price hits this, the trade is invalid. It's not based on how much you're willing to lose. It's based on the structure of the chart. There are a few common types of stop loss placement. 1. Technical stop, just below support or above resistance. 2. Moving average stop, below a 20-day or 50-day moving average. 3. Volatility stop, based on average true range. 4. Time-based stop. Exit if trade hasn't moved in a set time. Let's look at each. Technical stops. This is the most common stop used by price action traders. This method places your stop at a level that, if broken, invalidates the setup. You're giving the trade room to breathe, but you're not holding if the setup fails. Moving average stops. Some traders use key moving averages as dynamic support or resistance. For example, you may enter a trade above the 20-day EMA and place your stop just below it. Volatility-based stops. These stops use the stock's recent volatility to determine a stop loss. Use the ATR, average true range, to measure the average price movement over the last 14 days. Example, ATR is $1.50. You set your stop at 1.5 times ATR below your entry. This ensures you're not stopped out by normal price movement, but still protected if the trade truly fails. Time-based stops. This is a psychological and structural tool. If your trade hasn't moved within a set amount of time, say 30 minutes or 2 hours, and the market conditions have changed, you may exit early. This prevents you from holding dead trades or getting caught in reversals during midday lulls. Trailing stops, protecting profits as you go. A trailing stop moves with price as your trade becomes profitable, locking in gains while still giving the trade room to run. There are several ways to trail a stop: fixed dollar amount, percentage trailing, moving average trail, and swing high-low trail. Each method adjusts the stop differently as the price moves in your favor. Trailing stops help you maximize profits without guessing the top. You let the market tell you when the move is over. Reward to risk ratio, your most important metric. The reward to risk ratio tells you how much you're aiming to make compared to how much you're risking. The golden rule: never take a trade where the potential profit is less than your potential loss. A standard benchmark is 1, 2, meaning risk equals $100, target equals $200, reward to risk ratio equals 2, 1. Let's look at why this is so powerful. How reward to risk works with win rate. If your reward to risk is 2, 1, you only need to win 34% of the time to break even. Here's how the math works. 10 trades, 3 winners equals $600 profit, 7 losers equals $700 loss. Net, $100 nearly break even. But if you win 5 out of 10 trades with 2, 1 reward to risk, 5 winners equals $1,000, 5 losers equals $500. Net, $500 profit. This is the power of asymmetry. You don't have to be right all the time. You just have to make more when you're right than you lose when you're wrong. The 2% rule and compounding growth. The 2% rule says you should never risk more than 2% of your account on a single trade. Why? Because even with a 50% win rate, you can still compound your growth steadily while protecting yourself from catastrophic losses. Let's say you start with $10,000. You risk 2% per trade, which is $200. Average reward is 4% gain, or $400. You trade 10 times per month. If you win 6 of those trades and lose 4, profit equals $2,400. Loss equals $800. Net equals $1,600 per month. Managing losing streaks without losing your mind. Even the best traders experience losing streaks. The difference is, they're prepared for them. Here's how to handle losing streaks without blowing up. 1. Lower your size temporarily. If you lose 3 trades in a row, reduce your risk to 50% of normal. This protects your account during uncertainty. 1. Pause and review. Step away from trading for a day or 2. Analyze what's happening. Is the market choppy? Are you following your rules? 3. Journal every trade. Losing streaks often reveal gaps in discipline, not strategy flaws. 1. Avoid changing strategies mid-streak. Stick to your edge. Don't panic switch. Adjust your size, not your system. 5. Zoom out. Look at the month, not the day. One red day won't define you unless you let it spiral. Why risk of ruin is the silent killer. There's a concept in trading called risk of ruin, the probability that your account will hit 0 if you keep trading your current way. If you risk too much, or your reward to risk is inverted, your risk of ruin skyrockets. Example, if you risk 10% per trade, you only need 5 losing trades in a row to lose 50% of your account. To recover from a 50% drawdown, you need a 100% return just to break even. This is why small, controlled risk is non-negotiable. This mindset is what keeps traders in the game for years, while others burn out in weeks. Journaling, the trader's secret weapon. Every experienced trader has one tool they swear by, a trading journal. It's not just a place to log wins and losses. It's a tool for performance analysis, emotional awareness, and continuous improvement. What should you track? Entry and exit prices, stop loss and target, strategy used, market conditions, reason for entry, emotional state before, during, and after the trade, outcome and notes. Over time, your journal will reveal patterns. Are you losing more when you break your rules? Are certain times of day consistently better for you? Are you holding winners long enough? The journal tells the truth and helps you evolve faster than any course or book ever could. Building your own risk management plan. Let's summarize everything and help you build a custom risk management plan that fits your style, account size, and personality. Here's a 10-step checklist you can use and modify. 1. Risk per trade. Define your percent risk. 2. Reward to risk goal. Set a minimum. 3. Position sizing formula. Use risk, stop-loss distance. 4. Stop-loss method. Choose between technical, moving average, ATR, or time-based. 5. Trailing. Stop strategy. Decide if and how you'll trail profits. 1. Max daily loss. Stop trading after reaching it. 7. Max trades per day. Set a hard limit. 8. Loss streak. Rule. Reduce size or pause after X losses. 9. End-of-day review. Journal every trade before logging off. 10. Weekly review. Reflect, adjust, and repeat. This plan doesn't have to be perfect. It just has to be consistent and followed. You can always tweak it, but you must stick to it in real time. Final thoughts. Risk is your business partner. If you think of risk as your enemy, you'll always be afraid of it. But if you think of risk as your business partner, you'll learn how to respect it, manage it, and work with it, not against it. Professional traders don't avoid risk. They control it. They size positions based on structure. They cut losers quickly and let winners grow. They protect their capital so they can survive long enough to thrive. That's what this game is really about. Now, if you got value from this video and want to build a smarter, stronger trading strategy, now's the time to act. Like this video, subscribe to the channel, and share it with someone serious about trading. And turn on notifications so you never miss our next deep dive. We've got plenty more actionable content ahead. Legal disclaimer. This video is for educational and informational purposes only. It is not financial advice, and we are not licensed financial advisors. All trading involves risk, and you should do your own research or consult with a licensed professional before making investment decisions. Past performance does not guarantee future results.